Welcome to the investment panel. I'm Craig Sullivan, your host. I am the founder and principal of Click Media. I have an internet show called Click Connect, and we also tour and spotlight various sports and entertainment venues and hotels around the country. I've been involved and helped underwrite nearly $25 billion worth of hotel sales, construction loans, refinances nationally and internationally. And it is a pleasure to be moderating this panel. And John McClain, please tell the audience about yourself. You're muted.
Guess he doesn't have anything to say.
There we go.
All right.
John McClain, Fidelity Mortgage Lenders. And I funded trillions in loans. Just kidding. We are a private lender. We do loans from say 100,000 to 15 million. We're West Coast based, although most of the loans we do are in California. We're doing Oregon, Washington, Nevada, Colorado. We do quite a few loans in Texas. And I'm actually looking at a loan right now in Chicago that I normally wouldn't do, but it's a really low leverage deal. 3 million purchase. They want a $1 million loan. They want non-recourse, no prepay. So it's like, we're getting an appraisal quote for it right now. Let's see, we're kind of we're private, right? So we're higher than the banks, probably kind of in the 10.5 to 11.5 range. 11.5 might be land or cannabis or some things like that. But everything's non-recourse, so we can do nonprofits and churches and things like that. And we can do a lot of quick loans too. Most of the time, if we're not doing an appraisal, if it's really low leverage, when it's kind of in the 30-40% range, we usually don't need an appraisal. And we're probably funding in like a week, 10 days. But I would say most of the transactions are probably like 2 weeks, 2 to 3 weeks, especially 3 weeks if we're maybe having to get an appraisal. And that's about it.
Great. Thank you, John. Barry Judas is next, but before Barry says hello, I want to welcome a couple of old friends, Mike Clapper and Holden Lim. Good to see you guys. Appreciating you joining us today. Barry, it's all
Thank
you.
Hi, Barry Judas with Lantern Financial. We are San Fernando Valley based. We are also a private lender, making loans from maybe 50,000 to as high as 2 million. Our sweet spot would be 250 to 750 or 250 to 800,000 in that area. All property types, owner occupied, okay, but it has to be for a business purpose. We are not a consumer lender. We're a business purpose lender. We'll also entertain seconds. We will go as long as 20 years on loans, from anywhere from 1 year to 20 years. Stated income, no tax returns. We can lend on properties that are vacant with no income because we're primarily equity based. And then interest rates are going down. I know we will lend in the high 8s even if we had to on a loan that we really liked, but mostly in the low 9s to mid 10s. And if we would do church loans, which some people won't, we might be in the 12s on junior liens and maybe high 11s on church loans. So anyway, I'd love to hear from you all. We like those smaller loans, 250 to 8. That's Barry Judas at Lantern Financial.
Perfect, Barry. Thank you. Jimmy Lee.
Hey, good afternoon, everybody. My name is Jimmy Lee, Key Point Credit Union. We are a credit union based out of San Jose, California, in the Silicon Valley. What's different about us is that we offer a nationwide platform where we do loans in 50 states. We do investment, owner use, SBA. So we have a little bit of everything. What makes us different is going to be that we offer, I guess, 5-year terms, 5, 7, 9, 10-year terms. The most thing that sticks out for us is that we have no prepayment penalty on our loans. We do everything full doc. Everything's in our typical loan amount ranges from $1 million to $5 million. And we are probably max 65% LTV, and for multifamily up to 70%. We typically will ask for a higher ratio, at least 1.25 to 1.3. But then the thing about us is that there's a certainty of execution. We typically will meet with our loan committee just to pre-flag the deal, make sure it checks all the boxes for us. And by the time we ask for a good faith deposit, we have a certainty of execution on that. So, uh, local credit union, but with a nationwide platform. So, my name is Jimmy. Looking forward to working with you guys.
Thank you, Jimmy. Keith.
Hey everybody, my name's Keith Taggy. I'm from CoStar. I've been with CoStar for 14 years. So I've been through a couple cycles here and pretty much a Bay Area native. So there's not many of us, but Bay Area native. Primarily focused in Northern California. Uh, really focus on all asset classes. Only thing I don't touch on is single family home. Look forward to meeting you all today. Thanks for having me.
Thank you, Keith. David.
Hey team, David Rosenthal. I'm founder and principal of Curtis Rosenthal, your favorite commercial real estate appraisal firm. I started the firm back in 1983. We've been in practice for 43 years and we're starting to get pretty good at it. The thing that we offer that's really different is service. We'll talk to you, we'll listen to you. Obviously, we have to follow bank rules and all of that, but we are always very open to take a look at any market data that you want to submit, information about the property that you want to submit, run it all through the bank, but we welcome your input. That helps us to do our job better. And we're always here to answer questions and provide really good service. We are based in Southern California. We cover mostly Southern California, but we can do some work outside the area as well. So please put me on speed dial and call me when you have appraisal needs.
Thank you, David. You know, one of the many things you're going to find out about this panel is, information is key. That's why I'm so glad that we've got CoStar and STR represented by Keith, and we've got a stellar appraiser that handles all the food groups in commercial real estate. David's been at it for a long time and does a great job, and our lenders are second to none. And as I had mentioned earlier, they are all making loans. So we're going to kick this off with Jimmy. Jimmy, what type of loans does Key Point specialize in?
We specialize in retail shopping centers, mixed use, light industrial, self-storage, and medical offices. We like the big triple net buildings, but we're kind of staying away from the Walgreens, the CVS, and the dollar stores. But we do like the Starbuckses, the DaVita kidney dialysis centers, and the fast food chains right now.
Nice. I like that. What's your sweet spot on your loans?
Sweet spot, I would say anywhere from 800 to 1.5. Those are our typical average loan sizes. When it gets anywhere from like this $2, $3, $4 million ranges, that's when we start looking for participation in other lenders as well too. So to spread that risk. But if we're in that 800 to 1.5 range and we have a decent LTV spot, 65% LTV and a good cash flow,
Hi.
then we will be good on that. That's what we're looking at these days.
Love it. John, you do a lot of non-standard property loans. It's non-standard collateral. You got churches, schools, land, high-risk businesses. Would you go into a little depth on that for the audience, please?
Yeah, obviously there's a lot of vanilla transactions that go through, and we don't normally get calls on those unless they're down to, they've only got a few days or something like that. And then we pop in with those loans. But yeah, we do get a lot of calls for even land transactions. We don't do a lot of land, but if it's entitled, we can do that. If it's in a core market, we're not going to do land out in the boondocks. But we do end up getting a lot of churches and schools and nonprofits for a few reasons. We can do long-term loans. We don't just do the short-term bridge loans. We'll do a 15 or a 20-year. Our standard is kind of a 5-year interest only. But when we get a church or something, they usually want the 15-year, 30-year AM, or maybe a fully amortizing 20-year. They like that it's non-recourse because on these nonprofits, honestly, people don't really want to have to sign recourse for a church or something when they're on the board. So that works out well. And then we have no prepay. So if they want to, rates come down and they got a bank or something, and they can get a better deal, that's fine. So, and then also like the cannabis transactions, we're always low leverage on everything we're doing. Our highest leverage is maybe we'll go 55. We've done 60% like on residential Santa Monica, a good location or something. But most of the time we're doing 50, 40% loans. And, we're able to do them quick. And with cannabis, things like that, if it's a grower, we can do it. We're probably going to be 40%, like on a warehouse or something. And if it's a retail that's got H&R Block and there's a cannabis tenant, we might go 50% on that. We're not going to, make a big deal that there's a cannabis tenant. But it is something we can do. The property types, even like a theater, all of that, we could do that. We're probably going to be, land value, maybe 30, 35%. But it allows us, at least we can give an option.
Yeah.
And I think that's kind of what, especially like loan brokers, a lot of times we'll get a call and they're like, hey, we got to get, 1.5 million. And I'm like, looking at it, I go, we can do 1 million. And the payoff's 800. So maybe that's an option for you. Give me a call back if it is. Otherwise, good luck getting the higher loan amount.
Absolutely. And we'll talk about cannabis in a little bit. But, you guys did a deal for me. Client, lender backed out at the 11th hour. I brought Fidelity in and you guys had it funded and we closed 72 hours later. So that's an upside with both, John and Barry.
Craig, I got a question. Are these all nonprofits?
What do you mean by nonprofits?
I mean, in other words, churches and
They're lending across the board for
investing, huh?
Usually the church or school, a lot of times, yeah, they're nonprofits. So
Yeah.
that's,
On
I
those.
think, again, when we're doing non-recourse, we're not focused on having a guarantor. So we're able to do those. And that's kind of why we end up getting a lot of those. Plus being able to do longer term loans, not just, not doing we'll get a call from someone who's got a church loan and they've done a 2-year bridge, another 2-year bridge, and then they find us or they find Barry and they're like, hey, I can get a 15-year fix. Great. That's what I need. I don't want to keep going bridge to bridge. So yeah, a lot of those are going to end up being nonprofits.
Thank you.
Thank you. Keith, how would you assess the current state of Northern California commercial real estate right now? You're the man that's got all the data. So
Yeah, it's Northern California's back. Thank God. We've earned it. San Francisco office is leading the country in demand growth. San Jose, Santa Clara counties, top 10. Interestingly enough, East Bay is bottom 3 in the country as far as demand growth. Historically, vacancy is still really high in San Francisco, roughly around 20%. But we're still leading rent growth, 12-month absorption, and number 3 in sales volume. And primarily that sales volume is driven by institutional investors coming back to the market. Historically, values in San Francisco are still 50% of what they are at peak. And so a lot of institutional investors starting to come look at the city for getting a good deal where there's still some room for growth. As you move further south into Silicon Valley, top 5 for sales volume. But a lot of that, though, is driven by the users that have been acquiring deals for themselves because they're taking advantage. It's kind of like their last window. I don't think it's a big surprise, but AI and robotics is really leading this charge. And move-out activity has really slowed down because all the leases that were done pre-pandemic have been right-sized. Transitioning over to multifamily. Multifamily is booming in the Bay Area as well. If you look at average percentage of inventory versus absorption, San Francisco is leading the way. Part of that is we have no new construction really going on. I mean, there's a handful of projects in all of Northern California that are meaningful. And so because of that, we have huge demand with all these employees that are coming to Northern California. So we're seeing really high rent growth. If you look at the metro, San Francisco is roughly 9%, South Bay about 5%, East Bay is 3%. But really we're seeing growth in specific submarkets if you look at Mission Bay, which is where a lot of the AI leasing is happening, they're seeing 10, 12% rent growth. But if units turn, you're seeing rents go up 20, 30%. A lot of the AI companies, especially not the Claudes and then the open AIs, but the startups, they have this thing called 996.
Yeah.
It's where they expect you to be in the office 9 in the morning to 9 at night, 6 days a week. And they will, yeah. So it's really a way I think they can get away with age discrimination because, no one of the family's going to work from 9 a.m. to 9 p.m. 6 days a week. But anyways, they're also paying massive stipends if you live close to the office because they want you there all the time.
Right.
And so some of these companies are offering $40,000 base increases if you live within a 5-minute walk from your office. And so we're really seeing rent spike in those certain markets. Outside of San Francisco, we're seeing high rent growth, particularly around kind of easy transportation into San Francisco. So Alameda is seeing 4% rent growth. Cupertino, and just no supply, we're seeing 9% rent growth. But the delta between multifamily, a 1-bedroom in San Francisco versus a 1-bedroom Oakland, there's about a $2,000 rent premium to be in San Francisco. And so we're starting to see spillover effect in the multifamily office where people are saying, okay, I'll move back across the bay because I want to save $2,000 a month. And then, as everything kind of tying together here, CoStar owns STR, Smith Travel Research. San Francisco has been crushed from a hospitality standpoint. Things are moving back in a positive direction. There are some buildings that have some loans maturing, but if you look at ADR change over the last 12 months, San Francisco is number 2 with a 10% increase and top 10 for average ADR. So a lot of that is driven by business travel for those that are coming to visit the AI company. So overall, NorCal, we're on our way back. I don't think interest rates are going to drop anytime soon, but if they did, that would be wonderful to complete the cycle.
That would be nice, but I agree with you. I mean, there's a lot of factors. Current mayor and city council have been doing an outstanding job to bring
Agreed.
back the city of San Francisco. I will give a little bit of credit to the former mayor and that city council, but they came in a day late and $100 million short. You also have 40% decline in Asia Pacific travel to San Francisco, and Canadians were the second largest tourist group visiting California, and they didn't come back either. So, luckily the Park 55 and the other hotel that were turned into the lenders have been sold. Granted, it was less than replacement cost, but they're going to be up and running. The Huntington, which has been shut down for a long time, it's one of those living history hotels, is back. So it's all good. The newer sports arena that the Warriors have, there's a lot of positives. Every time I've been up there, it didn't matter if I was staying at the Fairmont, the Palace, or a plain vanilla Marriott, I felt comfortable walking around the streets. And, I miss some of my old eateries that didn't make it. But Barry Judas,
Sir.
why are hard money lenders reducing their rates in California?
Because they have to if they want to get any business. Well, except maybe John, because
Yeah, except for maybe
they're an
John.
institution. But other than Fidelity, I can't believe the rates I'm seeing now. My principal reminds me that, well, they say that they start at that, but reality is, unless it's a perfect loan, it's not going to be 799. It's not going to be 899. But I've been in this business longer. I can say this without hesitation, longer than everybody that's sitting here, even Leo Gluck, a lot longer. And I've never, it used to be a long time ago, hard money lending was 7 Jews in Los Angeles. Now, everybody's a hard money lender. And I just can't believe the amount of competition. Everybody thinks they can be a hard money lender.
Yeah.
What we really need, Craig, and I don't know if it's ever going to happen, is a 2008 shakeout to get rid of the people that maybe are stretching the envelope a little bit of some of the loans they do. But since that hasn't happened, more and more people are coming in.
That's an interesting point, and I think you are going to see that. I've been saying this for months now, that you've got a lot of people that are aging out, whether it's hospitality or office, investment companies, and they may not have another downturn in them. So we may see some of that. But, I really want to hear from you on what's more likely, a 1 or 2 point Fed increase in the second half of this year? Because it ain't going to go down this year.
No, it's not going to go down. So if you're asking me, I would say at least a half, maybe one. It's, the Fed rates they don't affect hard money guys as much as they do the institutional guys.
Yeah. Yeah, absolutely. That's where I think you guys have got a little bit more latitude. Again, you guys provide a service that's needed, and you're able to execute a lot quickly, more quickly than a lot of institutional people.
That's right.
David, you are our appraiser extraordinaire. Tell us about some of the niche markets. There's a lot of differences between Melrose, the Oceanfront Walk, and I don't know, Montana. You've got to be spot on with all the information that you're getting, and producing your appraisal. So what's it like doing some of these niche markets?
I'll tell you, that's something that we wrestle with a lot. We do a lot of appraisals in those niche markets, and as the world is becoming more automated, AI is becoming more prevalent, and there's a lot of data out there and available. These are the markets where an old school firm like ours, I think, really shines. The way to get the market information on those niche markets is to know the people that are doing the deals. We get to know them. We take them out to lunch. We roll up our sleeves. Something like Oceanfront Walk, the only way to really find out what's going on is to put on your shorts and your sandals and a pair of sunglasses and stroll down Oceanfront Walk. You got to walk.
I live at the beach.
Yeah, I mean, you know the drill. You can't just pick that up from a broad database because every property is different. And people guard their information so jealously. Nobody wants to tell anybody what anybody's doing. So the only way to get the real information and find out what's going on is to get to know the people. Same thing with some of the other markets. Montana, nobody likes to talk about what they're doing in Montana. The numbers are high, the market is strong, but certain buildings do better than other buildings, certain sides of the street, depending what's going on. Same thing with Melrose Place. That's such a niche little market. That one block,
Yeah.
it's crazy. And if you don't know the guys that are doing the deals, if you can't pick up the phone and talk to somebody, you're gonna miss the mark by a long way. And I've seen that happen. We've had lenders call us sometimes and say, hey, we engaged in appraisal. We had this property on Melrose Place, and they think it's in the middle of Melrose Avenue, and they're coming in at 50% of what the market rent is. Can you help us? Yeah, sure we can. But the only way to get there is just the old-fashioned way. You gotta get your hands dirty, roll up your sleeves, and talk to people.
Absolutely. Discrepancies. It seems, at least from my vantage point, that we're seeing more discrepancies, whether it's the building area between rent roll, public record, prior appraisals, and underwriting. Is that torture for you and your team right now? What's going on there?
It can be a real frustration, and it can make or break a deal. I'll never forget a property I looked at. It was on Ventura Boulevard in the Valley. It was a Conroy's. And the market rent at the time showed, it was a while ago, but the market rent showed that it was, I don't know, like 2.25. And I looked at the building. It was kind of an odd shape. The square footage just didn't quite seem right. So I went out and actually measured the building. It turned out the building was about 2/3 the size that they said it was. So that 2.25, the total rent amount didn't change, but the 2.25 actually became 4.25, which at the time was like a well above market rent. That had a pretty big impact on how to value the property. If we see something today where, like you said, where you have a discrepancy, So the rent roll says one thing, maybe it reflects the lease, but the public record says something else. The lender underwriting says something else. That's something that's got to be figured out. The size of a building, it is what it is, but on the other hand, it's kind of in the eye of the beholder. We've looked at properties downtown in the garment district where, on the one hand, you could look at the gross building area, but they're renting out little stalls. It's little stall spaces. So what are they really renting? The rentable or usable area there is just the little stalls that they're renting out. It's not the common walkway in the middle. So you've got to understand the market and really, again, talk to the people and figure out what's the relevant number to use for that particular property. And that can be the kind of thing that can make or break a loan transaction too. Because if you get it wrong, you just try to use a rule of thumb and you're not really understanding the market, you can come in with the wrong number and the lender is going to spit up on it.
You mean you're not flipping a quarter, heads or tails?
Well, yeah, we do that a lot.
Oh, okay. All right. Good. I'm glad to see that tradition hasn't gone out the window yet. I know it will with AI, though.
Yeah.
Jimmy, what makes Key Point stand out from the other lenders?
I would say, I guess we have our footprint in 50 states. I think a lot of places, anywhere you go, they're going to have some kind of prepayment penalty, some way, shape, or form. The fact that we don't offer it for our long-term loans is a big plus and draws a lot of folks to us. And we lend in tertiary markets as well too. So if it's a town out in Texas with a population of 25,000 or in a metropolitan area, we will consider it if it makes sense. So, every situation is different, as you guys know, but we will take into consideration all those factors and see if it's a right loan for everybody. So I think that makes us stand out from the rest of the folks that we work with.
I like it. Now, are you doing any loans in Hawaii right now?
We had a couple of inquiries, I've worked through it, but then at the end of the day, what I found out is the Hawaiian inquiries they like to stay with
Local.
in their own island. So I've dealt with a few of them, but then it's a little bit more challenging. But I think I've shown John a few in the past as well too. We wanted to go do a site visit, but it just didn't work out. Remember that one, John? The
I'm going to
office?
say,
Yeah,
take David. He can do the appraisal,
I'm ready.
exactly. Yeah.
And if John needs a backup or if they're going to split the loan with Barry, you guys can all go. So
Absolutely.
I'll call my friend over at No Vacancy, see if you guys can rent the corporate jet for that trip.
Yeah, there we go. Yes.
We'll go.
John McClain, I want to talk about cannabis.
All right.
Okay, so you're doing the growing, the distribution. What are you doing?
Well, of course, we're just doing real estate, right?
Oh, you're not saying
yeah. So we don't discriminate. We kind of handle a little bit of everything. The thing we're not into is, and I don't know how many calls. I feel like I haven't been getting as many in the last couple of months, but all of last year I would get calls for, hey, can you do this 25-acre property in Adelanto? And it's got these,
I got those
glass
After you turned them down.
houses, all that stuff. And I just tell them, call Barry. I can't do those ones. Just give Barry a call. And they're like, we want $10 million. It's like this tiny little building and all these acres. And
I
I'm
saw
like,
that one.
yeah.
I saw that one, John.
Yeah, but so yeah, we'll do those. We definitely stay lower on the leverage. Usually if it's, like maybe like a 40%, but we get stuff like in LA, Oakland, warehouses, things like that. A lot of those are growers or whatever they are. They're like, well, we make this or that, or we squeeze this out of it. We're kind of like, okay. Sometimes we'll go higher. Actually, I just quoted, I'm trying to think of where it is. I think Goleta. Had a property up there, and I think they're a grower. They're probably coming back. I quoted them, and they're kind of like, oh, I don't know, but I think they've got to pay off their loan in August. So I got a feeling I'll get a call probably in about a week, and they'll say, can you do this loan in like 2 weeks now? In other words, they've gone around, they've talked to other people, and they probably don't want to get a 2-year, 3-year loan. They probably want to get a longer term loan. I think it's about a 3 million, and the guy has good credit. I think it was at like 800. So we're probably going to do a 50% loan. Again, I think we'll probably end up doing this loan. Even though the borrower may think he's going to get someone else will come in, but so yeah, we'll end up doing those. Something that's a little different too. I just did about 3 weeks ago. I funded a $4.5 million loan on a 176 room hotel in Colorado Springs. I
Love it.
probably should have called you, Craig.
Yeah, you should have, because they've
I
insured
should have
almost
to
all of
get
them.
a little info on the property. But so, you know, that's an example. Again, it was low leverage, borrower had good credit, and he was into it for a lot of money. He had owned it for a long time, and they were just starting to rehab. They had some units offline, and they had a hard money loan. I think it had been extended, and they needed to get it again, and they had to get a payoff. So we ended up doing that. We did get an appraisal. You know, it's a little over our skis, so we went through all that. But you know, it was a good 4.5 million. That was a good
I
size
love
loan.
it. I love it.
So yeah, we'll look at a lot of things as long as we feel that the equity's strong. And as much as we're equity based, we still look at credit. If we've got someone that doesn't have good credit, it's not, I mean, in some cases we just won't do the deal
Right.
if it's really bad. But if they don't have good credit, we may look at it, we'll have a little bit lower LTV, but then we may also pull in a payment reserve, especially when we're funding and it's cash out. We'll say like, look, your credit's not good. This is a little bit of a tough deal, but we're going to hold back a 12-month payment reserve. You don't have to make payments for 12 months. And that way we can kind of get our investors okay. A lot of times the credit stuff can be a temporary thing. They need cash out. They got to clear some cards. They need to get, you know, they're maxed out on their cards. And once we wipe all of that out, then, you know, their credit score is going to go up. So we end up pulling in some from that direction too.
Great. Thank you, John. We're down to about our last 15 minutes now. So, hey, Keith, you got the best information. CoStar, STR, you're covering everything in commercial real estate. Now, I've been saying for a while that everything's going to change with AI. You know, whether it's a lender, an insurance carrier, you know, it's underwriting, it's everything. What are you seeing out there? What are you starting to hear from lenders and investors in their use of AI in today's market?
Yeah, sure. I mean, I think the main thing is everyone's trying to get verified data into their own models.
Yeah.
And the verified data is the hardest part to get. I've had more requests for API direct data than I've ever had here. Traditionally, it's been institutional people that have wanted that kind of information. Now it's everybody asking for it. And we're being selective on who we provide that information to or not for obvious reasons.
Yeah.
Things I think is changing the most is it's really kind of like the arduous tasks like lease subtraction. You know, you would take forever to do if you had a big building to go through all the leases. Now you can do that relatively quickly with AI. Also, if you look at like, you know, underwriting and broker point of view values, I'm seeing a lot of people take that data that they're getting from their brokers or, you know, whoever's submitting them that deal, and whether they're actually going to do the deal or not, people are using that data to plug into their models. I have folks that were, you know, underwriting one deal a week that are now doing 4 a day, and they're not necessarily going to do all those deals, but they want to train their model to work the best for the type of deals that they like to do. And the more data in, the more you can train it, and then your closed model can then verify that information. Everything still needs to be verified by humans, is what we're seeing today. Obviously, I think that will change, but phantom results are still real in AI. And then going to something you guys talked about earlier, building discrepancies. Obviously, it's a big thing in the market. CoStar owns Matterport. They've been doing interior and exterior 3D Matterport tours for years. We're able to use generative AI now to measure those buildings down to the square inch. So we will have basically a real point of truth for buildings. And we have like 1,500 drones that are flying throughout the United States and doing 3D exterior Matterports of buildings. So AI is making things go faster. I still think humans need to be involved. and everyone wants verified data. That's, where CoStar comes in.
Perfect. Keith, thank you. Okay, Barry, we talked about the plethora of lenders that are out there, on the private side and LTVs underwriting. But inevitably, we're going to have some real estate values decline at some point in the future. You thinking these companies that are the Johnny come lately is going to survive, or is it going to just be, you and John McClain left standing because these guys all overextended themselves?
I would love it if it was just me and John McClain standing, but no, there's we ain't the only smart guys in town. So a lot of people do it right. I mean, there are we know of a great many hard money companies that have been around a long time that don't need to make the mistakes that some of these new guys coming in, the new funds, they've got to get money out that they have to invest, because real estate's a very popular investment vehicle. If you don't own it, being secured by it, probably the next best thing. So I don't think we're never going back to the days that I mentioned before, with very few lenders in either Northern or Southern California.
Yeah.
It's going to be like this or close to it for the rest of my career, which is not going to be near as long as John's. But there'll be a fallout, and like you were saying, you think that's going to happen. You mentioned that there's going to be a downturn. I can't believe it's taken this long.
I hear you, and I got to tell you, okay, I own a half dozen hotels with partners, and I am not in the office every day. Okay, a couple times a quarter, that's about it. And right now, my deal flow is one. That's by design for me. I let my partners do everything. I'm looking at a deal on a tropical island out in the South Pacific right now to get it entitled and build a luxury resort.
Wow.
That's interesting to me. Okay.
Yeah.
I've done enough courtyards at Hampton Inns in my time. But thank you for that. David, I want to ask you the same thing. How's the use of AI going to affect the appraisals?
Well, it already is, and it's just a question of how people are using it. As we're training our staff, it's a tool, it's an assistant, it's not an analyst.
Right.
It's good for gathering information about an area, not so good at gathering data that you can use and rely on. We're still finding hallucinations where we'll ask for specific data and sometimes it makes stuff up. We can also tell, like we do review appraisals as well as direct appraisals. Sometimes we can tell, you look at an appraisal report, and you can tell what's written by a machine versus what's written by a person. And you have to call people out on that. And
Yeah.
it's tricky, and it's going to be evolving a lot over the next year or two. I know national appraisal firms are spending a boatload of money incorporating a lot of AI into their appraisal report development systems, and it's a little scary. It's the same reason I think that on the residential side that lenders haven't strictly gone to a Zillow or a Redfin type of valuation. They still get appraisals because every property is different. I'll give you an example. I'm in an office building, my office in an office building down by LAX. It's about 300,000 square feet. It's about 40% occupied because it's an office building down by LAX. So I asked ChatGPT to value the building. And it went through its whole thing. It did some pretty good analytics. It put together some pretty good information, and it came out at a value of about $60 million.
Nice.
Notwithstanding the fact that the building was taken back by the lender, put up for sale in the marketplace, and ultimately sold for $9 million.
I knew the other shoe was going to drop.
There's a bit of a disconnect there. So it's here. I won't even say it's coming. It's here. Everybody's using it. If they're not, they're missing out. But people have to be very, very careful about how they use it. And I'll give you one example of something that we didn't expect it would go sideways, and it actually did. One of my guys was we verify cap rates. We'll have like 5 or 6 different types of verifications for cap rates. We'll look at actual sales. We'll look at supplemental sales. We'll look at national surveys of CoStar, see what they say. We'll do a fundamental mortgage equity type analysis. So one of my guys reached out to ChatGPT and put in the parameters and said, "What do you think the cap rate ought to be?" And it came back with a number. Well, the number fit nicely in with what everything else said. So he put that in an appraisal report to a lender and said, "Hey, I asked ChatGPT what it ought to say." The lender got back to us real quick and said, "Whoa, whoa, 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 whoa. If you're going to do that going forward, we may have to look for a different vendor. You can't use anything, even though it was like one of 7 different verification methods. But no. Lenders want human touch. So it's
For the
all
time being. Now, I agree with you, but also you can bet your bottom dollar that Chase, B of A, and various others, as soon as they've got the security and the comfort with AI, they're going to pull a Jack Welch and they're going to start laying off 150,000 people a year.
Yep.
And that's when it's all going to change. So
Yeah.
we're down to our last 6 minutes. So I asked everybody in the panel to do a hero story. You know, how their company, themselves, their expertise saved something. So, John, I want to start with you, then quickly go over to Barry, Jimmy, Keith, and back to David, please.
All right. So I'll just take a phone call. Today's Thursday, right? I take a phone call I got on Tuesday from one of our lenders, not here today, but is active, saying, "Hey, John, I got a deal. Underwriter's going to kill it. The borrower's got an IRS lien, whatever. We already did an appraisal. I feel terrible. What can you do? It's low leverage." So I took a look. I talked. The borrower called me. She was very upset. She's got an IRS, or her mom has an IRS lien from a sale on a property. But got everything. Told her I need a loan application. So that was Tuesday. Wednesday morning, she sent everything over. And Wednesday night, I texted her, "We got this. We'll take care of it. Thanks. You already did the hard part of thinking about the text, filling out the application, just getting the paperwork over, the trust certs, all of that. I opened title, and I told her we'll probably get docs out maybe tomorrow, maybe Friday, but most likely Monday, Tuesday. But we'll fund by the end of next week." So, and I told her she could go have a glass of wine after I texted that. So she texted back. She's like, "Oh my God, thank you so much. It's been so stressful. I've been 6 weeks with the lender that needed extra stuff. Just to get the, okay, we're going to do it. It's all going to be done." So
Great
that was
story,
just the other day ago, 2 days ago. So
Very good.
that was kind of a nice
Barry,
one.
Barry, you got a hero story?
Well, mine isn't so much a hero story, maybe a little bit, but a couple of months back, we had a situation come up where a family, it was not an arm's length transaction. A stepfather wanted to sell a property to his stepson for like 500,000. That was appraised at like 1.2 million. So conventional lenders were out because it wasn't arm's length, and the purchase price was nowhere near what the actual value was. But it's like it was like giving an inheritance to the stepson, and it was on Catalina, where in all my career I'd never done a loan before, but it was in the city of Avalon, which I guess is the only city in Catalina.
Yeah.
So we made the loan, but the interesting part was the next day, the day after we recorded, the property burned down.
Oh, God.
No, and it was a duplex, and I think it was vacant at the time, and I suspect perhaps there was something that we weren't told or something we didn't know. It seems a little bit too incredible, but the day after the loan recorded, the property did burn down. So,
Oh my God. Jimmy.
I'm gonna tie my story back to John McClane, where he helped me close a loan a while back, where I had a multifamily that was considered a single residence occupancy, kind of like multiple units, dormitory style. Everything was shared. A lot of investors were not accepting those type of asset classes. I got the appraisal back. My primary investor said no, that's an invalid property. I took it to John. John looked at the appraisal, says, yeah, we can do it. He accepted the appraisal. We just did our due diligence on his end. About less than 10 days, we were closed and he took care of it. So, just having options to go to different, investment partners like everybody on the panel here, it's great. And, it helped me save a deal. So, I'm still going to give kudos to John every single time for that one.
Nice.
Thank you. That's very nice.
Very cool. Keith, how did
All right,
you
we
do
got-
that and how did you save a deal?
Well, we got 50 seconds left. So what I'll say is, we have a lot of clients on board here. So thank you all for your business. Any of you that are not clients, if you need any reports, help out on a deal. I've given out a bunch of reports it's a small industry. It all comes around. Y'all have my contact information. If you need any help, reach out. And if you want to hear my hero story, connect with me directly. More than happy to run you through it since we're out of time.
There you go. There's a way to go. David, quickly before Arnie turns us off.
Hey, mine will be real quick. It's something that happened yesterday and happens often. We do an appraisal for a lender. They have the appraisal reviewed. The reviewer has comments and needs corrections. A lot of appraisers out there sit on that for a day or two or three. It can kill the closing of a deal. My guys are trained. You get that in, you turn it around within hours, not days. We had one yesterday. Came in. The review comments came in by 1 o'clock. We had the revised report back to them by 3 o'clock. Deal closed on time. Everybody's happy.
Perfect. Thank you all, and thank you to our audience for joining us today. Everybody can be around so that you can talk to them and do some great networking today. And thank you for joining us again. Aloha, everybody.
Thanks for Craig.
Thanks, Craig.
Thanks, Greg.
Good job.